So Andrew Bailey, the governor of the Bank of England, has got in touch with the banks around the UK to make sure they are prepared if negative interest rates come into play. And in this video, I want to show you how it impacts you, going through the 6 areas that I think are the most important and how it's going to affect you moving forward. Welcome back to the channel, guys. I hope you're enjoying the content so far. Now, at this moment in time, interest rates have not gone into the negative, but it's something that looks like it's on the horizon, and I want to make sure you're prepared for this. So we've had Sweden, Japan, Switzerland, and Denmark go into negative interest rates right now, and Andrew Bailey, as I said, have already got the banks prepared for what's to come in the future. So the real thing to fear with negative interest rates actually isn't around the negative interest rates or even the direct impact of that. It's actually to do with its impact on inflation. So inflation is a good thing. It's to do with demand around services and products being higher than the supply around it, therefore increasing prices as we go forward. So the impact of negative interest rates isn't actually how it directly impacts the things that we're going to talk through. It's actually heavily linked to inflation and causing deflation and trying to stop that happening as a country. So companies, businesses, and the country survives based around inflation. So the Western world, the modern societies that we have are based on an inflation rate. In the UK, we typically aim for 2%. And it's the way that investments in things typically are paid off because of rises in prices. It's how corporate loans are paid off, and it's how businesses tend to make profits when they're moving forward. And what I want to go through in this video are the impacts on mortgages, savings, spending, credit cards and personal loans, property prices, how Brexit is impacting these things, and the dangerous cocktail if this all goes wrong, and if it does come into play, when will it stop? Okay, so with mortgages, we need to think about the existing mortgages and the new mortgages that are coming in. So negative interest rates probably aren't as exciting as you think they are in terms of, will the bank start paying me for the mortgages that we're coming out with? No, probably not. If you've got an existing mortgage and it's fixed, it's fixed. Okay, so if you've got it fixed for the next 5 years, that is what you're going to be paying, whether the interest rates go up to 10% or minus 10%. If you've got a variable rate, what you will start to see, or a tracker, is it will fluctuate, okay? So if negative interest rates do come into play, it's likely that the amount you're paying each month will reduce. However, in most loan contracts, in most mortgage contracts, there's something called a collar, which is a cap on how low it can go, okay? So you will always pay at least 0%. It's very, very unlikely you're going to go into negative and start to get paid from that. With regards to new mortgages, this is where it does get a little bit more complicated. There are some banks in, for example, Denmark, you've got the Jyske Bank, which is actually paying, or is at negative 0.5%. What that means is anyone that takes out a new mortgage with Jyske Bank is going to get paid each month for having that mortgage, okay? So each month going by, the amount of loan that they've got on mortgage is going to go down. I very much doubt we're going to see that in the UK for a lot of different reasons, but it is something to think about, that actually, if you are getting new mortgages now, this is not financial advice. Everything in this video is just my opinion, not to be taken as advice at all. Tick that box, is to get a long-term fixed mortgage. Okay, so Boris Johnson, PM right now, is trying to push for 25-year fixed mortgages. If you can get that at around 2-3%, I'd be jumping all over that personally. HSBC has just come out at 1.39% fixed mortgage for a 5-year, and that's going to really, really cheap. I cannot see it going much cheaper than that, so I'd be jumping all over that. With regards to savings, what this typically happens is negative interest rates coming to encourage spending. Okay, so I'll mix in number 2 and 3 together, savings and spending. Now, people will not want to save money. So what is typically going to happen is in the UK, the banks don't charge you to have money in the bank, where actually a lot of other countries do charge you for the protection of that money and the investment of that money. It's very unlikely the bank is going to start charging, because what will likely happen is people will just go, right, I've got 10 grand in there. Why don't I just take it out, keep it under the mattress or, in a safe place at home? So there's no point really saving money. And what it's trying to actively encourage is the increase in spending to make sure that that demand is there. My real worry is that going to be spent in the local economy? It's hard to see how, because a lot of spending habits have now gone online rather than in retail stores around your local vicinity. And so what happens is Amazon's going up, which is great for people in the logistics in the UK, and it's great for people that are working for Amazon and distribution channels like that, which is fantastic. But actually, most of Amazon is overseas, and so a lot of it won't be going into our local economy. So I would actively encourage trying to order from local companies to encourage and enhance the economy and therefore contribute to inflation. So I fully expect savings to drop dramatically and spending to increase, and I just hope that it's in the right areas. So when it comes to savings, are we likely to get charged? No. However, in a lot of banks, so for example, Jyske Bank that we spoke about earlier in Denmark, they are charging people to hold their money for higher income earners, okay? So what that means for the banks, by the way, when something's a negative interest rate, it means they are paying now to hold your money in deposit, okay? So that's why we typically don't get charged, because they're normally making money from holding your money in deposit, but now they're going to start getting charged from their central bank, if you like. What that means is it's costing them money. Should it cost you money? I don't think it will happen for the average person. Jyske Bank, if you've got in Denmark $500,000 or more, they're starting to charge 0.6%, which isn't a significant amount of money, but it's, you're still getting charged. And if you've got significantly more than $500,000 in Denmark, then you're getting charged 0.75%. Is it likely something like that will come over here? I think so. So if people have got $500,000 or more, I know that most people probably aren't in that situation. But if there is, what does that mean for you? Well, it's now even less reason why they would want to keep the money in the bank, because the banks don't want your $500,000 in there now. So it's more likely, if you're trying to find investors for your projects, your property projects, investments, whatever you're doing for your business, it's a much more enticing angle for an investor to take the money out of the bank and give it to you to get a healthy return on their investment. So guys, I hope you're really enjoying this video. If you are, make sure to hit the like button and make sure to subscribe if you want to learn more around property, investment and mindset. And we're going to move on to point number 4. So point number 4 is all around credit cards and personal loans. I don't think these are going to be impacted too much, okay? Now, I understand the negative interest rates are coming in, which will likely push down the cost. However, you have to think about other factors when you're looking into the macroeconomic impact to what's going on. So personal loans and credit cards, yes, the negative interest rates will push those down, but I think banks are going to be really concerned about the increased bad debt, which is debt that's not going to get paid back, and the realistically massive unemployment increases that are going to come. So if you've got your loans out, or you've got a variable rate personal loan, or you're thinking about getting a new loan, I would not expect there to be massive impacts to the rates of those moving forward. Number 5, and definitely the one that I'm most interested in as a property investor, is the impact on property prices. Now, there's no blanket rule. People talk about 2007, the big recession, how property prices just took a dive, but actually it's not quite like that. There were some areas that were impacted by as much as 30%. I know some areas were impacted by only about 4 or 5%. I'm going to break it down into price thresholds. Now, what's happening to unemployment? That's the direct impact of this. Unemployment is typically going to happen for the lower income earners, 25 to 50,000 pounds salaried employees. I'm sorry if you fit into that bracket, but typically they are more hands-on roles, they're more physical roles, and because of COVID, the negative interest rates, the impact on business, they are going to be impacted the most. So what I would expect is, yes, this lower interest rate's going to encourage spending with the 95% mortgages, the 25-year fixed rates is going to encourage getting these mortgages. However, because of the unemployment rates, I would expect that the increase in demand will not be as strong to the market with the £300,000 or lower price points. So I'd expect those prices to be stagnating or dropping slightly. Conversely, people that are earning higher incomes, much higher incomes than that, can typically do their jobs from anywhere because it's more direction, it's more online typically. Okay, so those earners with property prices of £500,000 or more, I would expect the property prices to carry on increasing in that remit because they are less affected by the negative interest rates and the employment rates moving forward. So from an investment point of view, I'd expect a slight contraction in the buy-to-let market and ready to increase later on into next year. Okay, number 6 is an external impact and just something to factor in with currency fluctuations, and that is Brexit, or as I have written on the board, Bexit. Okay, so Brexit, and how does it impact things? Well, what people seem to be forgetting right now is we are 3 years into the Brexit negotiations and they're starting to come through. So we've just had the ferry investment at around 70 million, which is great and pushing up against other currencies. However, these trade deals and no deals, deal or no deal, as it's coming through these negotiations, heavily impact the pound. So when you're looking at your money, whether you're going on holiday or you're thinking about foreign investments, just make sure you're watching those currency fluctuations coming through, because the negative interest rates mixed with Brexit is going to see the pound take a dive against the euro and against the dollar, which might not mean a lot to you right now, but your holidays are going to cost a lot more. And from an investment perspective, I think it's further encouragement to keep your investment local. Okay, so finally, I kind of want to go through the dangerous cocktail, the perfect storm, if you like, that's sort of coming on around us. Now, as I said, we need to spend money. If we don't spend money, prices decrease, which is deflation. And if it's prolonged, i.e. deflation is prolonged, we're likely to have mass firings, mass bankruptcies, because businesses are just going to, go out of business, right? And you can see the cycle as that's going along. Mixed in with that, what I'm really worried about is the cost of money in the bank is going to increase. So people are going to want to take out, this isn't really the person with £500,000 because it's not, these impacts are going to be less. But for most people with 10, 15, 20 grand in the bank, if you're getting nothing in the bank, or if it does come in where it's going to cost you, you're going to take your money out of your bank, you're going to have your cash sat there, you're going to want to spend it. And then once you spend, you create that new habit. And then, because they're trying to encourage lending and probably going to make it a little bit easier for that lending, I'm worried about people taking on loans, getting themselves into situations where they feel they can afford it. The bank's trying to help people buy properties, which really is just helping people sell properties for inflated prices. They take it on, and then I'm seriously worried about when the world gets back to normal, whether that's in 3 years or 5 years, interest rates start to increase. And most people don't think about the interest rates in 5 years. They're focusing on the interest rates today and how easily they've got their money. And so what I'm really worried about, this perfect storm of trying to stop deflation so much that it drives this spending, is it could end up going into hyperinflation, which is for another video, but also increase the risk exposure for the day-to-day person like you and I. So that in 3 to 5 years, we could see another mass sell-off of properties, a mass sell-off of businesses, disruption to business, mass firings, and bankruptcies as well. Okay, so I know a lot of this video have kind of been doom and gloom. I get it, but I really want to just give the accurate information from my opinion on the matter, and I'd rather give you what I'm thinking rather than make it all happy-go-lucky, right? Now, the truth is the day-to-day consumer probably won't be impacted that much, but it's really important to understand the macro effect of how this can come in and impact things if negative interest rates do come in. Now, if they come in, when will it stop? Well, as we said, inflation is really important to the UK and every country in the world, and it's where the demand is always slightly higher than the supply available. So it constantly pushes up the prices of everything and helps the growth of the country moving forward. So the target in the UK is a 2% inflation rate, okay? And so what will likely happen is this will be a short to medium term fix. And what will happen is as this negative interest rate comes in, the savings go down and people are increasing their spending, hopefully locally, and you're going to invest and spend your money wisely locally, then what's going to happen is in people with high amounts of money in the bank will likely get it out of the bank to investing people, hopefully local businesses, again, pushing that forward until the inflation rate of the country hits that 2% mark, moves forward, and then hits that steady 2% over 3 to 6 months. And then I think they will reverse that and come back into positive interest rates. So I know that is a really heavy video, possibly something you want to go back through a few different times. What we've incorporated this into this video is some chapters, so you can skip ahead if there's any sections of the video that you'd like to review without going through the full thing again. So I welcome you to do that. I hope you got a lot of value out of this as much as possible. Let me know if you agree, or in fact, if you disagree with my opinion on this, because that is what it is, just one guy's opinion, okay? Hopefully you got value. Hit the like button. Let me know in the comments if you agree or disagree, if there's anything else you want to talk about. And then of course, make sure to hit the subscribe button. And if you are a subscriber already, make sure to go across to the bell and hit that notification icon, and I'll see you in the next video. So welcome back to the channels, guys. So, okay, to see how prepared they could be, blah, 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 blah.